About to give you $20,000 cash. What's your move? Do you throw it in savings, buy stocks, pay off debt, or maybe gamble on crypto and pray for a 100x return? If you just froze up, you're not alone. Most people have no idea where to start. And here's what's crazy. Making the wrong move could literally cost you millions of dollars in lost wealth. But don't worry, because by the end of this video, you'll have the exact step-by-step investing roadmap to follow for building wealth efficiently. Priority 1, your emergency fund, aka your financial foundation. I know, it's not exciting. No one's ever gone to a party bragging about their high-yield savings account. But here's the deal. If you start investing before you have an emergency safety net, you're setting yourself up for failure. Before you even think about investing, you need a safety net of expenses in a savings account. This acts like a financial buffer. Imagine this. You skip the emergency fund, dump all your cash into investments, and then boom, your car's transmission dies. Now you need money immediately. You're forced to sell investments, maybe at a loss, plus pay any taxes and any fees. Your emergency fund has one job, ensuring you never have to sell investments at the worst possible time. Think of it as your financial shock absorber. For those with a stable income, you can do 6 months of expenses. For those with less stable incomes, aim for 9 months. Remember, this money is not for investing. This is your financial fire extinguisher, not your wealth building fund. Set this up in a dedicated, separate, high-yield savings account where you won't be tempted to touch it. Priority number 2, your 401k match. What if I told you there's an investment with a guaranteed, instant, 100% return, zero risk, and it's completely legal? Sounds too good to be true, right? But that's exactly what your employer 401k match is. Literal free money that most people leave on the table. This is an instant 100% return on your money, and basically is the closest thing to magic in personal finance. A 401k is a retirement investment account where you contribute a percentage of your pre-tax salary and pick what you want to invest in. But here's the magic part. Many employers will match what you put in. Every company's 401k plan is a little different, so check with your specific HR team. But here's an example of a common setup. Say your company offers a 5% match. You make $100,000 and contribute $5,000. Your employer automatically adds another $5,000. That's an instant 100% return before your money even starts growing. It's way better than whatever crypto influencers are shilling on Instagram. Many people say, but I have debt. Shouldn't I pay that off first? It depends. Getting a 100% return risk-free and instantly through your 401k is much better than paying off many types of debt. So there's a very strong case for contributing just enough to get the full match before aggressively paying off debt. Another common pushback is, but I can't touch this money until I'm almost 60 years old. And yes, ideally you leave this money alone to grow for decades. But let's say you absolutely had to pull it out early. Yes, you'd pay taxes on the withdrawal and a 10% early withdrawal penalty, but you'd still come out ahead because of the employer match. Remember, if your employer offers a match, contribute enough to get every single dollar out of it. If they match up to 3%, do 3%. If they match up to 8%, do 8%. This is literally free money. Priority 3, high interest debt, a silent wealth killer. High interest debt is a financial cancer. It drains your cash flow month after month and destroys your wealth building potential every single day. I consider high interest debt anything above 8% because historically, that's been the average return of the stock market, which means paying off high interest debt is actually a better financial move than investing. If your credit card is charging you 25% interest, paying it off is like getting a 25% guaranteed return on your money. This is something no other investment can promise you. So here's the game plan. Use the avalanche method. Target the highest interest debt first while making minimum payments on everything else. For most people, that means tackling credit cards before anything else. Remember, if you have any debt above 8%, paying it off should be your top priority. Forget investing for now. Your first goal is to escape the high interest debt financial quicksand. Priority 4, investing in yourself and increasing your income first. Are you ready for the most underrated wealth building strategy? It's not stocks, real estate, or whatever get-rich-quick scheme your former high school classmates won't stop DMing you about. It's you. Your skills, your career, and your ability to earn will build your wealth faster than any stock pick ever could. If you want to make more money, invest more, and actually enjoy life, the fastest way isn't by choosing the right investment, it's by increasing your income. Because when you earn more, you can save more, invest more, and build wealth faster without feeling like you have to cut every fun thing out of your life. How do you actually invest in yourself starting today? If you're a W-2 employee, stay market aware. Most people stick with the same company for way too long and wonder why they're not getting ahead. The harsh truth? Job hopping strategically is one of the fastest ways to increase your income. I'm talking 20 to 30% salary jumps instead of the standard 3% annual raise. If another company is willing to pay you more for the same full-time job, why are you staying put? Build a side hustle. Don't rely on just one income stream. You need income security, and that means not relying on one paycheck. Start something on the side. Freelancing, selling a skill, flipping products online, anything. Because if your job disappears tomorrow, you'll still have money coming in. And once you build a side hustle that works, you have options. You can scale up, turn it into a full-time business, or simply enjoy the extra cash. No more depending on one employer to control your financial future. Remember, the fastest way to build wealth isn't picking the right investment. It's increasing how much you can invest in the first place by increasing your income. Priority 5. Investing in index funds, the easy way to wealth. If you're someone who's like, I want to invest in the stock market, but I have no idea where to start, this section is for you. For 99% of people, the best investment isn't stock picking, options trading, or trying to catch the next meme stock. It's boring index funds, simple, low cost, and proven to build wealth without the stress of constantly researching stocks. But what are index funds and how do they work? Think of an index fund as buying a tiny slice of hundreds or thousands of companies with one purchase. Instead of trying to pick winners, you own a piece of everything. The beauty is in the simplicity. The stock market has gone up an average of 8 to 10% per year for decades. Most people don't have the time or interest to research stocks all day. Index funds let you invest, build wealth, and not stress about it. Here are some popular options. The S&P 500 index funds. These track the 500 largest US companies like Apple, Microsoft, Amazon, and Google. Many investors consider this the gold standard for long-term investing because these companies drive the US economy. The S&P 500 index funds allow people to invest in America's biggest and most successful companies. The NASDAQ 100 Index. These track the 100 biggest non-financial companies listed on the NASDAQ exchange. This includes a lot of tech-heavy companies like Tesla, Nvidia, and Meta. This is a strong choice if you believe in the technology sector. Total Stock Market Index. This allows you to own the entire US stock market, not just the biggest companies. This includes small, mid-size, and large-size companies, meaning it's more diversified than just the S&P 500, which is only the 500 largest companies. If you want maximum diversification, this is one of the best options out there. The easiest way to start? Open an account with a reputable brokerage. Set up automatic investments for an index fund every 2 weeks or monthly, regardless of price. That's called dollar cost averaging, and it helps smooth out the market fluctuations over time. And that's it. No complicated trading strategies, no stress, just smart, long-term investing that compounds over time. Remember, if you're not sure where to start, index funds can be a great first step. They're simple, low cost, and have proven to grow wealth over time. Priority number 6, low interest debt. Should you pay it off or invest? At this point, you're crushing it financially. Emergency fund, check. 401k match, secured. High interest debt, gone. Investing in index funds, on autopilot. So now, you're looking at your student loans, your car loan, or mortgage and asking, should I pay this off early or invest instead? And the answer? It depends. I know, that's the most annoying answer I could say. But here's why this isn't a one-size-fits-all decision. First, let's clarify what we mean by low interest debt. Some examples are mortgages, federal student loans, and car loans. Basically, if your debt's interest rate is lower than the 8% historical average return of the stock market, there's a case for investing instead of paying it off early. If we're looking strictly at numbers, investing usually beats paying off low interest debt early. Let's say you have a 4% mortgage. If you invest instead of paying that off early, and your investments grow at 8% per year, you're coming out way ahead in the long run. That's why most wealthy people don't rush to pay off low-interest debt early. They'd rather put that money to work. But before you go all in on investing, there's one more thing to consider. Not everything in life is about pure math. Some people just hate debt. They don't care about interest rates or optimal returns. The emotional weight of owing money keeps them up at night. And that psychological benefit has real value. If paying off your mortgage helps you sleep better, then that's worth something no spreadsheet can calculate. Because here's the deal. Money is just a tool for freedom. If eliminating debt gives you that freedom, then do it. Just be aware of the trade-offs and make sure it's an intentional decision. Remember, if you're comfortable with debt and want to maximize your returns, invest instead of paying off low-interest debt early. If you hate debt and it stresses you out, pay it off early, even if it's not financially optimal. Priority 7. Higher risk, higher return investments. Now we get to the fun stuff. The higher risk, potentially higher reward investments that everyone wants to talk about at parties. If you're looking at this step, make sure you've already built a strong financial foundation and you're ready to take calculated risks with a small portion of your portfolio. And let me be clear, this is only for a small portion of your portfolio. Let's talk about what actually qualifies as a higher risk investment. Cryptocurrencies, digital assets that have exploded in popularity over the recent years. Some people swear by it, others call it a scam. The truth? It's a high-risk, high-reward asset class that has made some people rich and wiped out others completely. There's potential for massive gains, but there's also extreme volatility. It's still a relatively new asset class and is only backed by supply and demand, not an underlying company. It's a lot less regulated compared to other financial markets, which means there's less help if anything goes wrong. Individual stocks. Riskier than index funds because you're betting on one company instead of hundreds. We've all heard stories of people turning $1,000 into millions by buying the right stock at the right time. Amazon was under $2 per share in 2001. Apple was under $1 per share in 2003. And Tesla was $15 per share in 2015. But here's what they don't tell you. For every success story, there are hundreds of failed companies that looked just as promising. Even professional investors with teams of analysts struggle to beat the market consistently. But sometimes you really like a company and want to be part of its individual story. If you're going to invest in individual stocks, know the company, understand the financials, and believe in its long-term future. Everyone wants to chase the next big thing. And yes, some people do get rich off crypto or picking individual stocks. But most people, they get in trouble when they put too much money into high-risk plays. That's why most smart investors keep high-risk assets at a minimal amount of their portfolio. It gives you upside potential without destroying your entire financial plan if things go downwards. Remember, high-risk investments can be exciting, but they should never be the foundation of your wealth. Keep them to a minimal amount of your portfolio so you can take advantage of opportunities without risking everything. And there you have it, the exact step-by-step investing roadmap that actually builds wealth. If you follow the system, you'll be miles ahead of most people who just throw money at random stocks, crypto, or whatever their buddy told them about at brunch. Let's quickly recap the order. 1. Emergency fund. This is your safety net of emergency money never to be touched. 2. Your 401k employer match. Do the match your company provides. It's free money, so take advantage. 3. Pay off high interest debt. Your money is working against you if you have high interest debt. 4. Invest in yourself. Your greatest wealth building tool is your ability to earn more. 5. Invest in index funds. Set it and forget it. Simple and proven investing. 6. Decide on low interest debt. Pay it off early or invest, but be intentional about it and know the details. 7. High risk investments. Only after everything else is in place, and only a small portion. This is the blueprint. No gimmicks, no shortcuts, just a smart, proven system for building wealth. Now I'm curious, what step are you currently on? Drop a comment below and let me know if there's anything specific you're struggling with. I read every comment and use them to plan future videos. And if this video helped you out, hit that like button, subscribe, and turn on notifications so you can see new uploads. Now, go take control of your finances, and I'll see you in the next one.